Hi, everyone. Thank you for being here. So we're going to talk about two things, really. We're going to talk a little bit about the difference between public and private blockchains, and I'm also going to tell a little bit of the story of my company and how it's developed over the past few years. And obviously, these two stories are closely interrelated. So the background for me was that as an owner of several websites, Bitcoin is in some ways very attractive and in some ways unattractive as a way to get money online from customers. It's irreversible, there's no one in the middle, it's cheap and direct, and that's a great thing. But if you try and explain to your accountant that you're taking money in Bitcoin or to the tax man that you're taking money in Bitcoin, it gets very difficult. So I started thinking as an entrepreneur about this field with the following question. Can we send dollars or pounds or euros over the internet in the same way? Just like we send Bitcoins directly without someone in the middle, can we send other types of currencies over the internet in the same way? Now, as luck would have it, in March 19th, 2014, version 0.9 of Bitcoin was released. And from my perspective, the most interesting feature in that version was the ability to add extra information to transactions, what's called transaction metadata, and we'll look at that in a moment. And so, not by coincidence, the day later, I founded this company with the idea of, well, what can we do with this transaction metadata? How can we enrich Bitcoin, add other services on top of Bitcoin using this data? So this is what it looks like. What you're looking at here is part of a Bitcoin transaction. It's a little bit technical, so I hope you'll excuse me from that. The first two lines are regular, they're called transaction outputs to which funds are sent. But the third line here is just arbitrary data. And you can embed arbitrary data in a Bitcoin transaction today. And you can put in text, you can put in a short hash which references some external file, you can put in a URL, whatever you want. This turns Bitcoin into a general purpose repository for storing data, and it's extremely secure because all of the computational power which we've heard about, which secures regular Bitcoin transactions that move money between participants, all of that computational power can be used to secure any other piece of data that you embed alongside those transactions inside the chain. First of all, at the start, it was only allowed to be 40 bytes per transaction. 40 bytes is an extremely small amount of data, and then about a year later, it became 80 bytes. But we're still talking about a very small amount of data that you can add to a Bitcoin transaction. If we think about this as a mode of communication, it has certain characteristics. First of all, anything you put in a Bitcoin transaction is public. The whole world can see it. Second of all, it is immutable, where immutability is a word that people misuse, but it is certainly very hard to change after it's been embedded in the Bitcoin blockchain. It costs a lot of money relative to the amount of data you're putting in. If you compare it to putting some data in the cloud, it is about 1 million times more expensive per byte, so a lot more expensive. But one interesting thing about this is you pay as you go. So you don't hire a monthly service in order to do this. For each time you want to embed a piece of information in the blockchain, you pay for that specific piece of information. So that's an interesting model. So this is a collection of characteristics that we have when we embed data in the Bitcoin blockchain. So the first product we developed as a company was called Coin Spark. And this was essentially a broad protocol for making use of that metadata field. So we had a number of features in Coin Spark. Number one, it was a way to move other assets around. This is something called colored coins. So essentially, you have extra data embedded in transactions that represent the creation of an external asset and then the movement of that asset between parties. So it's not dissimilar to the type of logic used in the ICOs that you heard about from the previous lecture, where you have something issued over a blockchain, which then moves between blockchain participants. We had the ability to embed numbers, long numbers inside transactions, a simple feature, so you could have payment references to explain to a merchant who you are when you make a purchase. And also, we used Bitcoin for notarized and encrypted messaging. So the idea is, instead of just sending someone an email, you can send someone an email which also references a Bitcoin transaction, and then there's a record in the Bitcoin blockchain when the email was sent, who it was sent from, who it was sent to, and what it contained. So this was an interesting feature. So we built a protocol which encompassed all of these features together. In practical terms, we were doing 1980s programming, right? For those of you who are old enough to remember what programming was like in the 1980s and ever did some programming, you had tiny amounts of memory, tiny, very, very slow computers, tiny amounts of space on disk, and you had to think of very clever ways to represent as much information or as much processing as possible in as efficient a way as possible. Programming today is nothing like that whatsoever, but that is what it was like when I started. So it was kind of going back to those days. In terms of what we delivered a whole bunch of open source libraries for people to use this technology, and we delivered a wallet that people could just download on their computer in order to hold these assets and send these messages and enjoy the other features. So we did this. We took about 9 months to build this product out, and we experienced, I would say, almost complete failure. First of all, there's a whole bunch of protocols today which can be used to move assets and issue assets over the Bitcoin blockchain. You'll hear from the guys at Colu later today. There's actually 6 that I'm aware of right now. When we started the company, there was kind of half a one, but by the time we released our product, and short period after that, there were already 6 different protocols. So, when people would ask us, well, why should I use your protocol instead of someone else's protocol? I could give them a bunch of reasons why ours was better in certain ways, but ultimately, these protocols all more or less do the same thing practically. So that was problem number 1. Problem number 2 is that's a graph of monthly visitors to the CoinSpark website from just regular organic searches. So it's quite a good measure of just kind of organic growth. Number 2 problem was this. If you want to have an asset, which is, say, denominated in dollars, which can be transferred over Bitcoin transactions. So in other words, I can take this asset, I can own it, and I can send it to you over a Bitcoin transaction directly. Who's going to issue this asset? Who's going to say, this token that you guys are moving from one person to another, this is actually issued in my name, right? Because if it's just a token with no one behind it, just a piece of data, what you really want it to be is something that a government or a reputable bank issues to say, I'm standing behind this token. If you hold one of these tokens in your wallet, you can come back to me and I will give you a real traditional dollar in exchange for this token. And the problem was, when we started talking to people about this possibility, there was just a whole bunch of closed doors. First of all, Bitcoin at the time had a lot of negative associations. Now, people are a bit more open to it, but at the time it was very negative. Second of all, if you think about this token, which I can transfer over a Bitcoin transaction, in legal terms, it's what's called a bearer asset. A bearer asset means an asset whose ownership is defined purely by who holds it. There's no central record. There's no one who can control who can buy it and who can give it to other people. It is simply who holds it. So a $10 note is a bearer asset. A bar of gold is a bearer asset. A share these days is mostly not a bearer asset. When you own a share in a company, it's not the certificate and the piece of paper that represents your true ownership. It is the fact that you're registered in some central registry as an owner of a share in a company. So over time, governments have been moving away from bearer assets. And the reason is that bearer assets can be used for all sorts of nefarious purposes. They can be used to fund terrorism, and they can be used for money laundering, et cetera, et cetera. So we were asking people to go back to the age of bearer assets at a time when bearer assets were going out of fashion in terms of regulation. So we weren't able to find anybody who seemed to us like a reputable issuer of these tokens who would stand behind it that we could use in our system. But there are companies still working in this space. Collie you'll hear from later on. And Tether also is one startup that decided to solve this problem by issuing the money themselves, which is not something we thought we wanted to get into, but one company has managed to do it. And the other thing that happened is, as time went on, the adoption rate of Bitcoin kind of slowed down. And so we felt like this wasn't going to be a rapidly growing thing. So I'm sure you guys, if you're studying entrepreneurship, you know what a pivot is. Everyone here know what a pivot is? Yeah? So at the end of 2014, we did something I'm sure you've also heard about called getting out of the building. And we started talking to people who were showing interest in what we were doing, even though they didn't want to build an asset and transfer an asset over the Bitcoin network. And we started talking to them. And at the same time, there was kind of interest starting to awaken in the financial world in this technology called blockchains. Why are blockchains interesting to banks? They're not interesting to banks in terms of Bitcoin, and we'll talk in a minute why that is. But they're interesting to banks because they enable assets to be moved between counterparties without an intermediary. So today, if Bank 1 and Bank 2 want to send money to each other, unless they're going to literally truck the money from one bank to the other, which is not very convenient if one's in Toronto and one's in Hong Kong, they need some intermediary in the middle who's actually holding accounts for both of them, and the transfer of money from one bank to another is actually taking place in that intermediary, which moves money from the account of one bank to the account of the other bank in that intermediary. But blockchains, in theory, allow banks to do this without an intermediary. Transactions can be settled in seconds, right? There's no issue of waiting to the end of the day to reconcile everything. These systems are very, very resilient. So instead of everyone being dependent on a single central point, they can create a shared peer-to-peer network to move tokens between each other. And regulators like this technology because it gives them an ability to have a real-time view on what's going on in a peer-to-peer transacting arena without waiting for reports once a week or once a month from the people inside that arena. So a regulator in real time can connect to one of these blockchains and view in real time exactly what's happening. And also what was happening, interestingly, is there were quite a few secret projects underway inside banks to play with this stuff. They were secret because at the time, banks were very, very scared about admitting they were doing something connected in any way to Bitcoin. But in practice, what was happening behind closed doors is developers inside banks were downloading the code for cryptocurrencies, starting to tinker with it and modify it to try and make it suitable for the kind of system they would want. So why don't banks like Bitcoin, first of all, right? You could use Bitcoin as a method for banks to send money to each other. Some central government could issue dollar tokens on the Bitcoin network, and then banks could use that tokens to send money to each other. Why don't they like that idea? And there's a whole long bunch of reasons why they don't like the idea. We've heard already about the low capacity of the Bitcoin network, which is currently a few transactions a second. It can grow, but nonetheless, systematically, if these systems are going to remain highly decentralized, they're never going to have very high transaction throughput. Who's in charge of the Bitcoin network? The truth is, a bunch of developers who spend a lot of time arguing with each other. Who's in charge of the Ethereum network? Well, there's actually a good figurehead there who seems to be doing a good job, but nonetheless, there's constant controversy about what should happen, how do we deal with problems. There was this hard fork in Ethereum, which some of you may know about. So banks can't work with that governance model, right? They don't know who to point to. They don't know who's in charge. No one knows what it's going to cost to transact over the Bitcoin network in the long term. Right now, it's around 10 cents per transaction in fees if you want your transaction to be confirmed quickly. That could go up, could go down. The miners who are confirming the transactions, in other words, your transaction is not going to really happen unless a miner sticks it in a block. No one really knows who they are, or no one knows who all of them are. Many of them are in jurisdictions which we are not comfortable with, or jurisdictions whose governments have a history of, let's say, not being financially liberal. Everything that happens on the Bitcoin blockchain is public, so everyone can see it. There's no ability to enforce. AML stands for anti-money laundering, and KYC is know your customer, the two connected areas in banks. There's no way to enforce who can transact on this thing, right? Once you have a token on the Bitcoin blockchain, anyone in the world can buy and sell it, right? That's great for people who are looking for that type of system, and I think Bitcoin is extremely interesting for a whole subsection of economic activity, but it's really bad for banks that are subject to regulation, because regulation doesn't let them do that. And there's a whole bunch of other things, technical reasons. It doesn't support assets very well, and it just gets very, very big quite quickly. So what did banks want? What they wanted is something which is a bit like the Bitcoin blockchain, but also quite different from the Bitcoin blockchain. So this notion of a shared ledger, where multiple participants come together to collectively manage a ledger, they're interested in that, but they only want it between a certain closed circle of participants. It's not open to the internet as a whole. They want to have control over the capacity and of the cost. They want to predict it and control it. In terms of the miners who validate transactions, they don't want it to be someone off somewhere in China. They want to know who are validating transactions and what governance model is in charge of those validators. They don't want to touch cryptocurrencies, right? Public blockchains, at least everyone designed so far, need some kind of native cryptocurrency token in order to power the whole thing and prevent transaction spam, right? Banks don't want to touch cryptocurrencies. This is a weird asset. It's not yet clear how it's going to be treated in terms of regulations. Banks don't want cryptocurrencies in their balance sheets. They just don't want it. They want to be able to administer these things collectively. They want them to be designed around the issuance and movements of other assets, right? So not cryptocurrencies, but other assets issued on the chains. And really, and this is disappointing probably for some people in the room, not so disappointing for those of us who are quite pragmatic as entrepreneurs. Blockchain is not an ideology, right? From how banks see it, right? This is not an ideology, this is not a revolution, it's not going to change the way the world works. This is a useful tool, right? And if you were to place it in the landscape of enterprise technologies, it is somewhere between messaging and databases, right? And we'll talk about that in a bit more in a minute. But this is a useful technology. So what did we develop? We developed a platform which makes it really, really easy to build this type of blockchain, right? So it's off-the-shelf platform. If you think about how companies today use databases like Oracle or SQL Server or MySQL, they install it, they configure it according to the documentation, and they've got an easy way to interact with it. That's what we developed for blockchains. Simple, off-the-shelf, easy to install, build your application on top of it. One of the most important things we did is we made it really easy to attach new nodes to the network. So if you think about these networks are meant to grow between multiple organizations, you want to make it really easy for a new organization to attach to an existing peer-to-peer network, so long, of course, as it has permission to do so. So we've tried to make that as easy as possible. We've tried to make it very easy for developers to work with, so we focused on the kind of common things that they really want to do. And one of the things we did, which I think was sensible, is we tried to make it as application agnostic as possible. So if you look at a lot of the blockchain startups out there right now, they're focused on particular use cases, supply chain provenance, or post-trade settlement, or all of these things. We tried to build a platform which is agnostic to application. And the reason we did that is obviously that broadens our user base. But second of all, we just kind of are taking our cue from the database industry. If you look at database platforms, they are application agnostic. They provide a series of functionalities that enables developers to build all sorts of different applications that make use of the technology inside databases, but they're not specific to a single application. And the other choice we made, which I think served us well, is we made it compatible with Bitcoin on a technical level. So although it doesn't connect to the Bitcoin network, all of the transaction formats, all of the APIs, all of the peer-to-peer protocol, as much as possible of how it works is based on Bitcoin. And that gave us a leg up in terms of developers being able to get started quickly using our platform. So here we have a more optimistic graph, right? This is another graph of monthly organic visitors to our website from unpaid searches. And unlike the previous graph, which never got above 1,000, this one is continuing to grow. It's now at about 15,000 people a month who are just coming from searches. There's people come from many other reasons as well to the website, and it's continuing to grow. So it looks like we've done a better job with the second product than with the first one, and that would be defined, I think, as a successful pivot. Why are we successful? Ultimately, The reason is we actually solved someone's real problem, right? There were people here who had a real problem. The people were the companies that wanted to build blockchain projects, right? They wanted to build a blockchain project inside one company or between multiple companies, and they needed a platform to build on. And they weren't able, or certainly didn't want to build their own platform. Blockchains are quite technically specialized. They're difficult to understand. Just like relational databases, if you look under the hood of what a relational database does, it's incredibly complex. Most companies that want to build blockchain applications don't want to worry about all that difficult, complex technology that's going on underneath the hood. So we just solved their problem. We gave them a platform, easy to use, that they can build their applications on top of. And actually, as it turns out, over time, the people using our platform are not banks. The people using our platform are solution providers, consulting companies, some of whom are building products for banks and some of whom are building projects for other types of entities. So, as often happens, our end customer was not the customer that we originally designed for. If I was to say what we're doing, for those of you who are familiar with the database industry, there are several different types of database. You've got your most common type, which is your relational database, called like Oracle and MySQL, and you've got all sorts of other types, key-value databases, in-memory databases, graph databases. And if I was to clarify what a private blockchain is, not a public blockchain, a private blockchain is a new type of database. That's all it is. And it's a type of database which enables multiple companies to share a database together, even if they don't trust each other, without having to put anyone in charge of that database. It's a peer-to-peer database technology. Multiple companies don't trust each other. In the case of banks, they actually are fiercely competitive with each other, but they can still safely share a single database. And that's what this technology does. Where is it useful? Well, transferring assets between banks, it turns out, is not so useful for that, or at least not yet, because the problem with using this type of technology for transferring assets between banks is that all of the banks in these networks can see what each other are doing. So if 2 banks conduct a transaction, the other 8 banks in the blockchain can see that transaction. Well, that's actually not what banks want, and in many cases, not what they're allowed to do under regulation. So again, the use case we originally built this for looks like it wasn't the right use case, but that's the way it goes. But we are seeing people build it for other types of systems. Number one, what I call lightweight financial systems, so financial systems which aren't so subject to regulation, or where there isn't such an issue of confidentiality. This is a very quick, easy, and efficient way to set up a financial system. Banks are using them as internal ledgers between complex banks with multiple subsidiaries, or for gift cards and loyalty points across multiple companies. Number 2 use case we see a lot of people building is provenance tracking. So how do you prove that an item you hold today and you buy in a shop actually came from the manufacturer somewhere in China 6 months ago? So a blockchain gives you a very good way for all of the participants in this supply chain, and there are a great number of them, to safely represent the transfer of an object, and therefore it's proof of authenticity between all of the parties in the chain. And the third thing we see is just general inter-organizational record keeping. So if you have a group of organizations that want to come together to create a collective record of something that's happened between them, this is a good technology for them to do it without having to take an external party to be in charge of that record. And once you're using a blockchain in this way, you can also encrypt a lot of the data so that not everybody who's storing the data can actually understand what that data means. And that's a good practical solution to the problem of confidentiality. So since we're talking a bit about entrepreneurship, one of the most important things we did as a company was write some very popular articles about this field. The most popular one was called Avoiding the Pointless Blockchain Project. This was actually an article in which we told most people to go away. Most people, we said, what you want to do with a blockchain doesn't make any sense with a blockchain, and we explained to them exactly why and what you need to have in a project in order for it to make sense to build on a blockchain. This might seem like a crazy thing to do for a startup, but actually it wasn't a crazy thing to do at all. Number one, it gave us a lot of trust, because a lot of CIOs and companies all across the world who are completely confused by the technology and the noise that's going around it, read this article, realized that actually 10 of the things I want to do on a blockchain don't make sense, but these 2 do make sense, and probably I should talk to these guys or use their product because they seem honest about what that is. And the other thing it helped us do as a company is it helped us focus on the use cases that actually made sense. So when we're building out our product and adding features, we don't want to add features that serve blockchain projects that don't make sense to do on a blockchain. We want to build features that do make sense, because they're actually going to turn into long-term paying customers if it makes sense for them to deploy a project on our platform. The other thing we did is we launched a partner program a few months ago. So many startups have this temptation to go into consulting, right? We had people all the time asking us to build blockchain projects for them, because obviously we're experts in the field. But we didn't want to build a company like that. It's hard to scale a profitable company like that, or at least a highly profitable company like that. And second of all, it just wasn't very interesting for us as developers. So we started working with many consulting companies who do have incoming projects asking to build blockchain applications for them. And we partner with them. We help them use our platform. We promote them. They promote us. And so there's 20 companies now in in the partner program, including some names you see here, and there's quite a few more, including some big names who we can't yet publicize, but are coming along the way. And that seems to us like a very good way to go. Is instead of us trying to do everything, we're focusing on that core technology element that we know how to build, and we're enabling hundreds and thousands of developers to build on our platform, and they can serve the broader audience. So of the money that they're being paid for those projects, we will only end up seeing a small part rather than all of it, but it's a practical approach for us as a small, focused company to get to reach a very large number of customers without having to directly interact with them ourselves. So what is our business model going to be? So, and our roadmap. So we'll be releasing the beta of Multichain 1.0 in the next few months. We spent 18 months adding features from the first alpha release. This is a difficult judgment call because you want to get to a 1.0 release. On the other hand, it was clear to us once people started using our platform how many things were lacking in terms of what they wanted to do. So I hope we've judged it correctly, and we're going to be releasing 1.0 beta in the next few months. We're already providing the ability for people to purchase service-level agreements from us, so people that want formal support from us for a live deployed project on our platform, we'll sell that to them today. And then over the next couple of years, we're going to be developing a premium version. So I'm sure you're familiar with the freemium business model. This is simply a freemium business model. Right now, we have an open source platform which people can download and use for free, and we intend to use that as a way to get to as much of the market as possible. And then we'll have a premium version of the product with a whole bunch of extra features which isn't open source and isn't free, and those people that want to upgrade to the premium version of Multichain can do so. And one of the key things that we're going to have as a characterization of the product is that it's going to be possible to mix free and premium versions on a single network. So if 20 companies set up a blockchain together as a way to interact with each other, not all of them have to upgrade to premium just because one of them wants to. And that's very, very important, because if you look at the procurement process in large companies, it can take 6 months or a year to sell a piece of software. So you try coordinating procurement between 20 companies at once, it's going to be impossible. Whereas if we can sell to each one individually based on if and when they want to upgrade, that gives us a way to grow these networks and start selling some premium versions of the product without having to require everybody to buy at the same time. Ultimately, we're just a database software company, right? And there's a lot of talk about private blockchains, and there's a lot of hype about it, and a huge amount of nonsense is spoken about it. Ultimately, this is just a new type of database, and we are building a database software company. If you find that boring, by all means. For me, that's very interesting, because this is a very new type of database, and there's a huge number of technical challenges that we have to solve to create a very successful product. And the other thing we're doing is we're keeping the company very lean and focused on our product development. There's a lot of companies out there who are competing with us, have raised vastly larger amounts of money, have far less product than us and far less users than us, and that's great for them, but I don't think they're going to manage to create a sustainable business in time to support those valuations and those investment rounds. I think it's going to take a long time for this to grow, and again, we look at the history of relational databases and how it took a long time for that new type of database to take hold, for the application models to become clear, and for the businesses to grow, and we think we're going to see a similar thing happening here. And so we're assuming that right now we are in the early stages of probably a 20-year process of this new type of database finding its suitable use cases and taking hold in some companies. So that's why we're keeping it lean as a result. So that's the end of my prepared talk. Happy to take any questions.
Regarding private blockchains, maybe you can help me wrap my head around this, because I don't understand how mining is done. There's no economic incentive for the token like there is in Bitcoin, where it's public and you don't have to use this. For example, so 10 banks and a consortium using this private blockchain, what's the benefit of the miners? How do you randomize the mining?
Yeah, so there's a few ways to do it. I can tell you how we do it in our product, and that's quite representative. So first of all, the miners don't make any money, right? On the other hand, it doesn't cost them any money, right? They're not doing proof of work. They're not solving difficult computational problems. Miners in our product are simply one of the participants creating a block and signing that block to prove that they are the source of that block. And then there are consensus rules in the blockchain or in the network which say it's more or less like round robin, but it's a little bit more lenient than that. So essentially, after one of the participants has added a block to the chain, they have to wait, say, at least 10 blocks created by other people until they can add the next block in the chain. So you can enforce distributed consensus once you have permission miners without requiring an economic incentive. But you need to have people signing the blocks they made, and then you have rules about how often a single entity can create a single block. So structurally, it ends up looking quite similar to Bitcoin, but the mechanism of getting there is quite different. So we're not talking directly to governments, but we know about, some projects that have been done for governments on our platform, so we kind of indirectly know what's going on. And they're all covered by any number of NDAs, so I can only talk in a very, very general way. The most clear way in which you can intersect this technology with governments appears to be the idea of a blockchain for a country, where the government of that country issues money onto that blockchain directly. So just like governments today issue money through the banking system, and they issue money through printing notes, they can also issue money by issuing tokens onto a country-level blockchain. And if that's the case, then they would be able to have all the same ways in which they enjoy being the money issuers that they have in any other kind of type of money that they issue. But I haven't heard of any government expecting to kind of extract a tax per transaction, because they don't extract a tax per transaction today for just regular bank transfers, unless it's a commercial transaction. So I haven't heard of any governments trying to extract a tax per transaction from these types of systems. So it's a permissioned blockchain. So there's many different ways to do permissioning, but you can have a simple rule, for example, that says that no transaction can take place unless it's approved by one of 20 banks, right? So essentially, one of 20 banks have to digitally sign a transaction. And at that point, the moment a bank signs a transaction, it has to check it if it's over a certain amount. So there's many ways to solve that problem once you have this kind of closed permission network. Right. Okay. So first of all, the notion of settlement finality, that after a transaction is done, after a certain amount of time, it is finalized and cannot be reversed, that is a notion which is subject to legislation and regulation. And you cannot claim settlement finality in the Bitcoin blockchain. You can claim it on a practical level, but you cannot claim it on a legal level, because there could always be a fork in the chain, and it could be a reorganization. So that's one big problem for them. The second big problem for them is, and I say this as a person who is long on Bitcoin, has invested in Bitcoin, the biggest challenge to Bitcoin, most likely challenge to Bitcoin in my viewpoint is a government, which doesn't like it. And if you take some of the large governments of the world, if they decide to attack and bring down the Bitcoin network, they have the resources to do so, if they choose to do so, either by becoming miners themselves and then undermining the network by having most of the computational power, or by just rolling a couple of tanks into some of the big mining operations in their countries and seizing them physically. So I think from the perspective of, say, Western banks, the idea that there's even a conceivable risk that something could happen in some other country around the world which breaks their financial system, that's not something they can live with. So first of all, it's not so much the same solution. If you actually try building an application on our platform and on other platforms, you'll see they're quite different. We are more like a general purpose shared database platform rather than specific to any particular banking use case. But the answer I generally give people to that question, if they are a potential user, is I say, just try it. And usually they try it and go, oh my God, that was much easier than anything else we've tried. So that's the short answer to your question.
Gideon.
No problem.
Thank you.